I'm Lucian Cook and I'm Head of UK Residential Research at Savills. So our latest residential research publication is looking at the speed of recovery in the UK housing market and whether or not that is sustainable over the short and medium term. And I suspect that as more mortgaged buyers come back to the market and interest rates rise themselves, that will slow the pace of house price growth. That house price growth will be driven by earnings much more than anything else. London has been outperforming the rest of the UK for a 9-year period. Now, typically, London will outperform the rest of the UK for somewhere between 8 and 10 years. So it should be getting towards the back end of that period where we would expect actually London to slow and other parts of the UK to see higher rates of house price growth. There seems to be political will across all parties to increase levels of house building. Those levels of house building will reflect activity in the UK housing market. Amongst the under 35s, we've seen levels of home ownership fall by over 40%. And for those younger generations, it's likely that they will stay in private rented accommodation for a longer period and for further life stages. Now, the big question is whether or not those buy-to-let investors can continue to meet that requirement amongst private renters, or in reality, if you need other people to enter the market. And we are beginning to see much more activity amongst institutional investors. Over the period of the next 5 years, at a UK level, we think that there can be price growth of 25%. But there are already some things in the system which would suggest that the market will slow. Mortgage market review is high amongst them. The prospect of interest rate rises is another. And it's the timing of those interest rate rises perhaps that will dictate the pace at which we see that market slow.